So we got you a very special guest on the show today to discuss what are the factors which are playing. Very shortly, we would be joined by Ashok Wadhwa of Ambit on the show. But before that, let's also take a look at how the commodity space is actually doing. Very shortly, Ashok will be joining us in moments. Commodities also is an area which really did phenomenally well. PSU banks did very well. SBI is getting some attention after the commentary coming in from the MD. All right, so let's go to Ashok. He's right here with us. Ashok, good afternoon. Thank you so much for joining us. Great chatting with you after a long time. A lot of things are playing on the mind of the market right now. There is a, if you just took note of the third quarterly updates which are coming in, and the note at which the third quarter earnings season has started is positive, but a lot of people are questioning how much of this positivity from corporate India on earnings front at least is already factored in. Let's start by understanding your views, because you work with corporates across sectors very closely. What's the kind of sense you're getting in your interactions?
So I think, Adesh, first let's look at, we're starting a new decade. Let's look at the decade from 0 to 10 and then 11 to 20. And actually, you will see that in the first decade of this particular century, earnings and market kind of moved in tandem. There was really no re-rating of the market at that point in time. But if you take the second decade, which is the 11 to 20 decade, you will see that the Nifty earnings moved at literally 1/2 or 40% of the market, the Nifty 50 stocks moving, which effectively shows that there has been a re-rating of the multiple in this period. I'd like to believe in some ways that that's reflective of what is happening today. The market multiples on which stocks are trading today, I would argue, are significantly greater than the market earnings. But that's also partly because we're coming out of a very difficult negative feeling of a pandemic, which was like a black box in front of us. And with now the arrival of vaccines and with the kickstart of the economy, there seems to be enough and more positive sentiment. So I'd like to believe that the earnings will show a sharp increase. Obviously, we are coming from a very, very low base. But I would also like to believe that the market is perhaps quoting at a significant variance to just the earnings, because of a very, very positive sentiment backed up by a huge amount of FII flows at this point of time. I tend to agree with what former Governor Raghuram Rajan said, that there is reason to feel positive and optimistic about the earning uptake, but perhaps we need to be a little cautious and not over-predict this optimism at this point of time.
It always pays to be playing conservative, Ashok, and I think that's the kind of sense I get from you. Fair point. We should take one step at a time, and rather than going all the way too excited about this recovery. But what are you sensing on the shape of the recovery or the quality of recovery when you speak to your research team, which is really digging into the numbers, or when you work with all these sectors, companies across the sectors? Does it look durable to you, or it is still shaky?
So two comments there, Adesh. We were always of the opinion and have continued to remain of the view that the recovery will be more in the K shape versus a V shape or a W shape. There are segments that will recover fast, and we have already seen that. There are companies that are going to, grow, really coming out of this pandemic very aggressively and hopefully make up for some of the lost time. We are seeing that. And there will be sectors and segments that will remain on the slow path. I mean, you look at tourism, you look at travel, you look at hospitality, you look at entertainment. These are segments that were deeply affected by the pandemic. And obviously the recovery out of that negative feeling and negative sentiment is bound to be a little slower. What is very obvious is that the upper end of the K has shown a sharper and perhaps a more resilient growth curve back whether it is in the agri sector. You can see Mahindra and Mahindra, great example of that. You look at the recovery in the commercial vehicle sector, the likes of Tata Motors and Ashok Wadhwa. And even, I would argue, several of the consumer companies. I would argue, if you look at consumer credit uptake over the last perhaps 30, 45 days, a very short period to predict anything firm at this point of time. And I'm cautious of the fact that our regulator has kind of cautioned us and told us that, we shouldn't get over optimistic about the challenges that the lending sector, particularly the NBFC sector, will face. But I would argue and say that if we were sitting here 60 days ago, we would have not felt as optimistic, and we could not have predicted that the recovery will be perhaps as sharp and as resilient as it has been. So I go back to the original point that it was bound to be a K-shaped recovery. It is coming up like a K-shaped recovery, except the upper end of the K is showing greater resilience and more positive outcome than many of us would have predicted 60 days ago.
Etc. How is the deal flow now? Pharma and chemicals clearly is an area where we have observed a lot of private equity and institutional money is keen to take stakes in. But what are the feedback? What are the inquiries you are getting in your investment bank end of the team? Which kind of assets and sectors are we seeing big chunky flows or long-term money wanting to get parked in?
So I think, Ajay, let's divide that into listed stocks, and let's also look at it from a unlisted perspective. I think there is growing interest for foreign investment in both the FPI segment as well as the FDI segment. In the FPI segment, the winners are quite obvious. I mean, almost everybody is a winner, but the bigger winners are quite obvious. IT is leading the way, digital is leading the way, pharma, chemicals. We saw Mrs. Bector's IPO. We saw the outcome of Burger King. Before that, we saw Chemcon, an IPO that we led. So I think the winners in the listed segment are clearly the broad range, starting from IT on one side, chemicals, intermediaries, pharma, food. On the unlisted side, there is immense amount of capital again in the whole digital space, in the whole e-commerce space. The startup space continues to attract a lot of attention and a lot of capital at this point of time. Infrastructure continues to be a recipient of very large doses of capital. Real estate is one new appearance in that whole space. One did not realize 6 months ago that real estate could make such a strong comeback, and whether it is just the reduction of stamp duty, that can't be the only cause. Some of the other regulatory changes that the government has announced, including the rates on which transactions can happen. I think a sum total of all those has made real estate again a relatively attractive sector, and we're seeing lots of investment. We're talking about the follow-on QIP that Embassy did on their REIT. We are aware that there are one or two other REITs that are looking at coming to the market very, very soon. So I would argue and say that in the unlisted space, startups, digital, infrastructure are big recipients. In the listed space, it's pretty much across board, perhaps led by technology, pharma, and chemicals, and then followed by several other sectors in the food segment, the QSR segment, which is where Burger King belongs.
Ashok, we are also, in the run-up to the budget 2021, on the one hand, many believe that government steps are not really restricted to the budget. They have taken a lot of steps outside of it already, need of the hour, and they can take a lot of steps outside of that. But markets' curiosity, and they look up to budget as a big event, and it always happens. How is the market positioned ahead of the budget? What would it take from the government side to really impact the market any positively, because it's already run up quite a lot, big flows, big position expectations are high? What are your thoughts?
So I think, again, it's a unique opportunity from a government perspective. Still early in its election period. We all know that the government has a very strong reason to kind of ignore a bit of the fiscal issue this year, given the pandemic and the damage that the pandemic has caused. The government can leverage that position to be far more liberal in its whole approach. Anything that can, again, support consumption, because that's the area where people are feeling still a little uncertain, tentative. Is this just an immediate reaction of the vaccine being foreseen in the marketplace? Is it a real comeback on part of consumption? Anything that the government can do to prop up consumption would certainly be a good idea. I mean, this is one of those times when between creation of new capacity and incurring capital expenditure, listen, interest rates are at literally all-time low. The last time we saw interest rates as low as this was the 2003 time period. And it's interesting, isn't it, that was the Vajpayee government, and the Vajpayee government probably kick-started one of the largest private sector, CAPEX cycles. And we are again around the same rate of interest. Liquidity is abundant. Can we now kickstart the private sector investment cycle one more time? Very critical to creating new opportunities, new jobs. And I think the government has already made some initial announcements in terms of PLIs and including more and more sectors in that desire to focus on manufacturing. So I would believe concessions to support manufacturing, concessions to create more employment, even disinvestment. I mean, I would again say that if you look at the share of PSU institutions, it's perhaps at the lowest ever. It's now standing at 10%. All the PSU market cap put together is at 10% of the total market cap of the market. Also, if you try and decipher this a little, Ajay, you will see that companies in which government is a minority shareholder, the government is generating serious amount of returns for itself. Axis Bank, ITC, Hindustan Zinc, companies where government sits in control and is managing the affairs of the business are perhaps underperforming at this point of time. Is there a cue for the government to take here and say, we are better off being an investor, sitting on the board, ensuring good governance of these companies versus being in management? Should this not be, initiation like the Vajpayee government did of another big dose of divestment? Government's been promising that. Perhaps a good time for government to take advantage of where the markets are and the messages that are coming and start that. It'll help everybody. And as I said, at this point of time, it will also help them address perhaps the shortage in tax collections because of the pandemic and the contraction in earnings.
Right. All right, Ashok, we'll let you go on that one. Thanks so much for joining us. Clearly, cautious on markets, optimistic on economy, and hopeful from the budget appears to be your stance right now. Great chatting, Ashok. See you soon once again, perhaps after the budget. That was Ashok Wadhwa of Ambit talking to us about markets and how the corporate India is actually navigating through this slowdown and what's expected from the government on the policy front. Time for a very short break. On the other side of the break, we'll talk about other sectors which are making news right now and stocks which are moving. More analysis on the other side.